Picture this. A buyer gets pre-approved, finds the home, gets their offer accepted, and finally starts picturing where the couch will go. Then, because they are excited, they decide to buy that couch and maybe the matching bedroom set. And maybe they open a store credit card because the salesperson says you could save 10% today. A few days later, the lender calls and says, "We need to talk." That is the part nobody wants to hear. One wrong move after applying for a mortgage can create a serious problem with your approval. And the scary part is, most buyers who run into trouble never saw it coming because they thought once they were pre approved, they were safe. So, in this video, I am breaking down 3 things that can kill a mortgage approval and how to avoid them before they become expensive, stressful, or heartbreaking.
The first thing that can cause problems is opening new credit or making large purchases. This includes buying a car, financing furniture, opening a new credit card, or taking on any new debt before closing. Even if the payment seems small, it can affect your debt to income ratio, which is one of the things lenders look at when deciding whether your loan still works. This does not mean you can never buy furniture or make changes to your life. It just means you need to wait until after closing or talk to your lender before doing anything that touches your credit. The second thing that can create issues is changing or leaving your job. A lot of buyers assume that if they get a better job or a higher paying position, that is automatically a good thing for the loan. And sometimes it can be, but not always. Underwriting is looking for stability, consistency, and documentation. So if you switch jobs, change how you are paid, move from salary to commission, become self employed, or leave your job entirely, it can trigger more questions, more paperwork, delays, or in some cases, approval problems. The third thing that can cause trouble is moving large amounts of money around. This can be large deposits, transfers between accounts, cash deposits, moving money from a family member, or shifting funds without a clear paper trail. Lenders are required to verify where your money is coming from, especially the money being used for your down payment and closing costs. So even when the money is completely legitimate, an unexplained movement of funds can slow things down and create extra conditions. The key is to keep everything clean, trackable, and easy to document.
You do not have to walk through this process scared, and you do not have to know every lending rule on your own. The best thing you can do is communicate with your lender before you make any major financial moves, before you apply for credit, before you transfer money, before you change jobs, before you deposit a large amount into your account. Ask first. That one quick conversation can save you from a much bigger problem later. The safest approach is to stay consistent until closing day. Keep your employment steady when possible. Keep your banking activity simple. Avoid new debt. Do not make major financial changes unless your lender has reviewed it first. Buying a home can feel stressful enough without worrying about losing your approval over something preventable. But when you know what to watch for, you can move through the process with more confidence and fewer surprises. So if you are currently under contract, getting ready to apply for a mortgage, or thinking about buying a home soon, please do not guess your way through this part. Ask the questions early. Talk to your lender and make sure you have the right people guiding you before a small decision turns into a big problem. If you are buying in Lake County or the surrounding Central Florida area and want someone helping you stay ahead of the details, reach out anytime. I would much rather help you avoid a problem than try to fix one at the last minute.